Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. My name is Bert Salazar, as all of you know, and this is January 3rd of 2019. So we want to, obviously, and I want to wish each and every one of you a wonderful, happy 2019. I hope that all your goals and your objectives and your dreams come through in 2019. But most important, if you want to make any changes in 2019, you have to start now. You also need to write down all of your goals and objectives, because if they're not written, chances are they're never going to come true for you. So you got to make certain that you make some changes. You know, the definition of insanity is continuing to do the same thing over and over again, while expecting a different result. Today, we're going to be covering part 3 of the 3 IRS tax buckets. And today is the name of this podcast will be the pros and cons of the tax-free bucket. Now, obviously, as most of you know, those of you that have been following us for the last year, we're celebrating our 60th episode today. So I'm very, very excited. We're getting a lot of accolades from many of you that, you know, have given us a lot of kudos for all the information and, most important, all the education that we have been providing for the past year and a half or so since we started doing these podcasts. So again, we're now dealing with part 3 of the taxable buckets, and I think it's very critical to understand that the more that you understand how the IRS is going to tax every single product or service that you acquire in this country, and many a times for those of you that do business outside of the United States, how they're going to be taxing those products, the better off you're going to be in maximizing your internal rate of return while minimizing any tax liabilities that you may have in the future. Now, in part 1, we talked about the taxable bucket, and we talked about the pros and the cons and the advantages and disadvantages of the taxable bucket. And because of the fact that just about everything inside of that bucket is taxable, it is apropos for each and every one of us and each and every one of you to limit the amount of money that you should have in that bucket. Obviously, you can always go back and listen to that podcast again for more information along those lines. Then in part 2, we went into the tax-deferred bucket, and that's a bucket that most Americans have a tendency to understand, at least on the advantages side and the pros side of the bucket, but many of them do not understand the disadvantages on the con side of the bucket. So we went into a lot of details. That podcast obviously has received a lot of positive feedback. So again, for those of you that are starting to think more about tax planning moving into 2019 than ever before, I do recommend that you go back and that you listen to that podcast once again. And again, today we're going to be talking about the final bucket, which is, to me, the most important bucket and the least understood bucket in the IRS tax code, and that is the tax-free bucket. Now, what are some of the advantages in this bucket? Number one, it is the most efficient wealth-building bucket in the tax model. If you truly understand how the tax-free bucket works, then the vast majority of the assets that you would own today would be in the tax-free bucket from a business perspective. Number two, it is the most creative leverage bucket for income and wealth in the tax model. And because of the tax benefits that you obtain on the back end of the bucket, then you do have the ability to leverage all of the income and the wealth building capabilities of that bucket as well. It is, number 3, the best positioned tax bucket for wealth creation and wealth recapture, and I'll talk a little bit about that in the next few minutes. Number 4, it provides an economic multiplier effect, which increases the velocity and or efficiency of your money because of the 7702 plan capabilities that are found inside of that bucket as well. Number 5, it is the most efficient tax bucket in the economic model. And the reason for that is that taxes are paid on the seeds, not on the harvest. You see, if you were a farmer in the United States, the question is, well, would you rather pay taxes on a few bushels of seeds in the spring or on truckloads of harvest in the fall? And then obviously understanding where taxes are going to be in the future. And we did spend quite a bit of time in part 1 and 2 talking about the tax liability that we as a country have today and where those taxes are going to be 10, 15, 20 years from now. Then obviously you may be better off paying taxes on the seeds than on the harvest. Now remember, for many, many years, we really didn't know when taxes were going to go up in the future. Well, now we know. Now we know that January 1st of 2026, taxes will be going up, deductions will be going down, so the tax effect on each and every one of us is going to be much greater on January 1st of 2026 than they are today. So because of the fact that we just went through 2018, now we only have a 7-year window in which to be able to maximize all of the benefits that the Trump administration has given us through the new tax laws that were implemented January 1st of 2018. Number 5, it is this bucket, the tax-free bucket, provides for systematic growth of assets. Number 6, the assets in this bucket are tax deferred during accumulation. Number 7, they're tax-free during distribution, and this is a big, big plus for this bucket because this is the only bucket that allows you to take all of the distribution on a tax-free basis. Number 8, it'll provide provisional income benefits. And number 9, it will provide Medicare premium benefits as well for all of us that are able to maximize the contributions to the tax-free bucket. Now, like every bucket, there's nothing perfect. So there are always advantages and there are always disadvantages. Now, what are some of the disadvantages? Well, you know, same as the tax-deferred bucket that we covered in part 2. For a number of years, at least in the tax-free bucket, you lose the care, custody, and control. You lose the 3 C's. Now, except for municipal bond funds and 7702 plans, every other investment inside of the tax-free bucket does lose the care, custody, and control because of the IRS rules, and I'll go into a little bit more detail on that in the next few minutes. Obviously, another disadvantage is that taxes are paid on the contributions, but that could be blessings at the end of the day, because if taxes are to go up in the future, then I would rather pay taxes on the contributions than on the distributions. For Roth IRAs and Roth 401ks, obviously, you also have a disadvantage, a liquidity disadvantage. And then obviously you also have the early withdrawal penalties, the 59.5 rules that are applicable to the Roth IRAs and the Roth 401ks. And most important, you also get no tax deductions for any stock market losses that you may incur in the future from a business and market perspective. Now, as most of you know, based on the conversations that we have had in the past, there are only 4 vehicles that are suitable to go into the tax-free bucket. You have your municipal funds, your municipal bonds. You have your Roth IRAs. You have your Roth 401ks. And you also have your 7702 plans, which are your cash value life insurance plans. Now, these life insurance plans we do on behalf of our clients that wish to maximize their contribution to the tax-free bucket are different than what most advisors in the marketplace would do. You know, we're a retirement strategist firm, so our number one goal is to maximize the contribution to the tax-free bucket because we need to have limitations in the taxable bucket and also in the tax-deferred bucket. So, you know, once you hit and meet the limitations or the maximum or the optimum contributions to the taxable bucket and the tax-deferred bucket, then every additional dollar that you have in your personal economy should go toward the tax-free bucket at 100%. Now, something interesting to consider, municipal bonds and municipal muni bonds from a business perspective are not totally exempt as a tax preferred bucket because of the fact that although the income generated from municipal bonds is federal income tax free upon receipt, it does not meet my personal guidelines from a tax exempt perspective. I consider tax exempt if you pay no federal income taxes, if you pay no state income taxes, and if you pay no capital gains taxes, and if it doesn't have a negative impact on your Social Security benefits in retirement. Well, if we apply the rules of engagement, then we find that although municipal bond funds are received federal income tax-free, they may not be received state income tax-free. So if you live in Wisconsin and you buy a municipal bond, let's say in Illinois, obviously you're not doing anything for the state of Wisconsin, so you know the state of Wisconsin is gonna tax you at the state level on the income generated from that municipal bond fund because it's not a fund that you obtained in your jurisdiction. So from a taxable perspective, it's not considered true exempt. Now, let's say that you invest in a mutual fund or in a bond mutual fund. At some point in time in the future, you may want to, or you may wish to sell that mutual fund portfolio. And although you may have been receiving that mutual fund income free from federal income taxes, if the value of the mutual fund portfolio increased, then obviously you will have to pay a capital gain on the difference between the value of that mutual fund muni bond portfolio when you purchased it versus the value at the time of sale. And again, and last but not least, although the muni bond income is received federal income tax-free, it gets added on to the provisional income calculation in order to determine what percentage of your Social Security benefits may be taxed in retirement. So although municipal bonds do go in the tax-free bucket because they're free from federal income taxes, you have to be very careful when you use them because you may create other tax liabilities that you may not wish to do so. Now, the next product in that bucket is your Roth IRA, and Roth IRAs are totally exempt. Roth IRAs do not have any of the issues that you would find in municipal bonds. Now, they do have some limitations in the sense that, you know, you can only contribute so much based on IRS rules on an annual basis. Also, if you put money into a Roth IRA, You also have to deal with the 59.5 rule, so you cannot take money out prior to age 59.5 unless you're willing to pay for a premature distribution penalty of 10%. There are obviously other guidelines at the 5-year rule and so forth. But for the most part, once you hit the age of 59.5 and you've been in that fund for at least 5 years, or you opened your Roth IRA at least 5 years earlier, then there's no tax liability whatsoever. Another great benefit of the Roth IRA is that you don't have to deal with the 70.5 rule for required minimum distributions as you would have to in your traditional IRAs or your traditional 401ks and so forth. By the way, that rule also applies to municipal bonds. Municipal bonds do not have the 59.5 rule or the 70.5 rule, so municipal bonds do have a tremendous amount of liquidity, but again, you have to be careful not to offset some of the state taxes and provisional income calculations that we mentioned a few minutes ago. Now you also have another product inside of that bucket, and that would be your Roth 401k. Again, as you all know, the contribution to this bucket is after tax. The money grows tax deferred, and you pull it out tax free. Now, Roth 401ks have some of the same features as your Roth IRAs. You know, they have the 59.5 rule and so forth, but the Roth 401k structure does have the 70.5 rule or required minimum distributions rule that you need to be aware of. So whenever I'm dealing with clients that have monies in their 401ks and they're getting ready to retire, one of the things that we recommend is that they move the assets from the Roth 401k to the Roth IRA, and once that transfer is completed, then the 70.5 rule is totally abolished. So because now the Roth 401k has become or has been transferred to a Roth IRA, there are no more liabilities for required minimum distributions, which, you know, if you don't know the rules about required minimum distributions, or RMDs for short, then there is a tax liability of 50% excise tax or excise penalty liability on the amount of money that you should have taken out of that Roth 401k, but you didn't at the age of 70.5 or older. So you have to be careful, but then again, if you do your due diligence and you move your assets from the Roth 401k to the Roth IRAs, then you're going to eliminate that liability from your portfolio moving forward into the future. So it's very, very important that you understand how this tax-free bucket works. The final product in the tax-free bucket, and we've talked about municipal bonds, we've talked about Roth IRAs and Roth 401ks. The final product is the 7702 plan, which is cash value life insurance plan. And although it is situated inside of the tax-free bucket, it gets taxed under a different set of circumstances than any other product in this bucket. Number one, the contributions to the 7702 plans, just like the other products that we have discussed, are after tax. The money grows tax deferred, and then if you do it the right way, you can pull the money out on a tax-free basis through distribution up to cost basis, and then shifting to loans at some point in time in the future. The beauty of the 7702 plans, it gives you the insurance or the death benefit leverage that you don't have into any of the other products. So it does allow you to increase the velocity or the efficiency of any type of money distribution out of this asset. And it also provides a number of other benefits. Number one, the 7702 plans do not have to worry about the 59.5 rule because it is not applicable. So it acts pretty much as a municipal bond fund from that perspective. Also, 7702 plans do not have the 70.5 rule. So whenever we do any type of planning for clients wishing to maximize and increase the efficiency of the tax-free bucket, we always use a straddle or a combination of Roth IRAs, Roth 401ks if available, and obviously 7702 plans because of their capabilities and efficiency. You see, at the end of the day, if you want to get to the 0% tax bracket in retirement, you cannot do so just with one or two products. You need to have a combination straddle that will have a number of products in place, and you may very well have to use all three buckets available in order to maximize that capability. In other words, using a portion of your taxable bucket, your tax-deferred bucket, and obviously the tax-free bucket that we are discussing today in part 3 of this scenario. Now, one of the reasons why I recommend maximization of the tax-free bucket to the vast majority of my clients is the fact that if you do it properly, then you can reduce your tax liability to as close to zero as you possibly can, or you can reduce it to a point in time where your tax liability is going to be minimum from a business standpoint. Remember, if 100% of your income in retirement is tax-free, then if taxes were to double in the future, well, 2 times 0 is still 0. So that is something that you need to take with you. Also, as you start thinking about 2019 and beyond, I'm going to give you some final thoughts that I think will be very good for all of you, especially since we are early in January 2019. Number one, you want to maximize the amount of assets that you put in the tax-free bucket. You need to use a future value calculation, and that's a calculation that we use with all our clients, because if we're able to reduce your tax liability either now or in retirement, then that means that you don't have to take such a high risk in investing your assets and having to deal with, stock market volatility and interest rate volatility, because you're able to offset some of that potential liability by having more money in your pocket at the end of the year due to the proper tax planning that you have done. Now, you also may want to contribute any excess that you would have put into your qualified plans or your tax-deferred bucket. You need to contribute that to the tax-free bucket. In the tax-deferred bucket, when it comes to qualified plans, we always recommend that you should fund it up to the match and not a penny more. And at the very, very worst, no more than 7% of your income, because there is a fine amount of dollars, there's an optimum amount of dollars that you must keep in your tax-deferred bucket if you want to avoid major tax liabilities in the future. You also want to shift annual after-tax earnings and or contributions to the tax-free bucket. If you have IRAs or you have traditional 401ks, then you may want to start thinking about doing IRA conversions. Also, you may want to start making contributions. If you were making contributions to traditional IRAs, you may want to start making contributions to a Roth IRA and or a Roth 401k if you have such a vehicle available. If you happen to be an employee with an employer that provides not only a traditional 401k but also a Roth 401k as well. Now, one of the things that we need to keep in mind is, why are we doing all the planning? Why have I spent so much time in walking you through part 1, part 2, and part 3 of the IRS tax buckets and how it is that they tax all the products and services that we own here in the United States? Well, it's very simple. Today's national debt is almost at $22 trillion. So there's a very high probability that taxes are going to have to be a lot higher in the future in order to offset that liability. Also, if you take a look at the unfunded liabilities, and those are the liabilities that the U.S. government has promised to all of us as Americans, and they don't have the money to be able to pay those promises in the future. So when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest of the national debt, that exceeds $115 trillion. Also, the national deficit, between what we take in every single year and what we pay out, for the first time in history, it will be at $1 trillion in 2019, and it can only get worse. So as you really start taking a look at the future when it comes to taxation, and the fact that there is no other way in which to raise revenues than by increasing taxes, because that's what governments normally do, and also by reducing benefits at some point in time in the future, or a combination of both, there's a very high probability that taxes in the future are going to have to double, or our country is going to go bankrupt. So if you happen to be in the 12% tax bracket today, well, it'll be 24. If it's 24, it'll be 48. But if you happen to be in the 0% tax bracket and you have a 7-year window in which to maximize your tax planning, because of the fact that we're living in the third lowest tax bracket history from a business perspective in the history of our country, then you don't have time to wait. Many of you have already wasted 2018. Because you haven't done any tax planning. So the offer that I'm making to all of you today is the following. Number one, make 2019 the big day for you to start shifting, and the big year for you to start shifting from tax preparation to tax planning. It's a major difference between the two of them. So if you're interested in creating a tax planning blueprint, please feel free to reach out to me. You can reach out to me at area code 786-766-1042 to learn more about it. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com. You can also email me at Bert, B-E-R-T, at bertsalazar.com, and learn more about the features and benefits of having a customized tax planning blueprint. Now, what does it entail? It entails a number of things. Number one, tax preparation. Now, you may want to continue to use your tax preparer, but if they don't have the ability to do tax planning for you, then it's going to be quite challenging for you to be able to accomplish a tax-preferred retirement distribution planning. So I do encourage you to take a look at that. Feel free to call me and schedule a 30-minute no obligation consultation. It will be a free consultation, so we can discuss each and every one of your personal issues you may have from a financial perspective, and then you'll be able to determine whether we could work together or not. I'll be able to determine whether any other services that we provide can be suitable to you, your business, and your family. But tax preparation, one of the things that we do for our clients is, we're able to maximize the 14 tax-preferred deductions in the code that many of our clients miss, and many tax preparers miss along the way. We also do a tax-forward planning report as part of our customized tax planning blueprint. And the tax planning forward report provides a proactive future tax planning calculation that can assist each and every one of you in reducing your annual tax liabilities by thousands of dollars on an annual basis. That is a big reporting that we do for our clients, and we spend time going through this report with our clients to make certain that they understand, how to enhance and how to reduce that tax liability in the future. The next part of the tax planning blueprint that we do is we provide a Social Security report in which it deals with what is the optimum Social Security benefit trigger. What is that critical day in which it makes the most sense to start taking Social Security distribution. It would also provide part of the report the optimum Social Security benefits tax minimization reporting. Is not only figuring out what is the best day for you to start pulling Social Security benefits, but also what is the best and the optimum day in which you can pull those Social Security benefits without increasing your tax liability, and hopefully if you've done proper tax planning, that you can receive those Social Security benefits on a tax-free basis, as opposed to having up to 85% of all of those benefits taxable to you in retirement. We also provide, as part of the Social Security report, we provide a Social Security replacement strategy. Interesting to note, the vast majority of the clients that I engage that are already taking Social Security benefits have not done any Social Security replacement planning whatsoever. That means that a husband and wife, when one of them passes away, the surviving spouse can either keep his or her Social Security benefit or take the higher one of the two. But by taking the higher one of the two or keeping their own, they're always losing one of those Social Security benefits. And when families are used to receiving two Social Security paychecks on a monthly basis, and they've been doing so for years, they may now be forced to take more money out of their other assets in order to offset that Social Security income because of the fact that they were not able to do proper replacement planning. By the way, if you don't do proper replacement planning, or if you don't do proper provisional income calculation to reduce and or eliminate your Social Security taxes in retirement, you may very well run out of money anywhere between 5 years and 14 years when you include both of these sooner than expected. So this is very, very critical. The vast majority of the clients that we engage for the first time have never ever done any proper due diligence when it comes to tax planning and Social Security benefit in the future. The next report that we would do for all of you, if you're able to engage our services in order to create a customized tax planning blueprint, is a retirement distribution report. And this will include a bucket distribution efficiency because usually when clients come to see us as they're getting close to retirement, they pretty much have all of their money in one bucket, maybe a little bit in the taxable bucket, but all of their assets are in the tax deferred bucket. So we need to make certain that we create bucket distribution efficiency and also bucket straddle distribution programs in order to reduce and or eliminate tax liabilities in retirement. So the longer the period that we have between the time that the clients start doing tax planning to the time that they have to retire, the better off that we could do. And then last but not least, and this is a critical part of having a customized tax planning blueprint, we will create and do for each and every one of our clients a Fatal 4 risk management report. And this is a report that deals with managing risk in retirement. And there are 4 major things that Americans need to pay attention to, that all of you on this call need to pay attention to when it comes to retirement. The risk of dying too soon. What will happen to your family if you don't wake up tomorrow morning and you have a premature death? the risk of living too long. Americans are living a lot longer today than they ever did in the past. The risk of living with a disability. Yes, because of the fact that Americans are living longer today than ever before, they are more susceptible to having to live with a disability and having a need for long-term care. And long-term care can take and erode your assets and your retirement assets, not only for yourself, but also for your potential surviving spouse, unless you've done proper planning along those lines. And then last but not least is living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits. So there are many issues that come into play when it comes to retirement planning. Sadly enough, the vast majority of Americans have never really thought through, and sadly enough, the vast majority of advisors that our clients have been dealing with and Americans have been dealing with for years are not tax planners and or retirement strategists. So, when was the last time that your advisor had a discussion with you regarding provisional income calculation, or the 3 IRS tax buckets in retirement, or how to create economic straddles in order to minimize the liability and inefficiencies in those buckets? When was the last time that your financial advisor ever talked to you about taxation of your Social Security benefits and the negative impact that the taxation of your Social Security benefit would have on your life? I would argue that for the vast majority of you, this is something that has never happened, and you don't want to wait. You don't want to wait till 2020. When was the last time that your advisors came to you and talked to you about minimizing your tax liability, and the fact that you have a very fine window? Is now a 7-year window until such time that taxes will go up as of January 1 of 2026. And by the way, January 1 of 2026 is just the beginning, because what's going to happen in 2028 and 2030, when now Medicare and Social Security are going to have those major issues that experts have been talking about for the last 10-15 years, that Congress has been kicking down the road without paying attention to it, because it would become a political nightmare. But at the end of the day, it will become a nightmare for Americans living in the United States and abroad. So again, as always, I want to leave you with one final thought, and that not only what we did in 2017 and 2018, and the information and the education that we have provided through all the podcasting and seminars and webinars that we do, our number one goal for all of you is to help each and every one of you change the way that you do things. Because when you change the way that you do things, the things that you see change. Again, Happy New Year to all of you. Welcome to episode 60 of our Cambridge Financial Literacy podcast, and your tax-free retirement podcast, and your tax-free life. And look forward to spending time with you every single week for 2019 and beyond. And again, feel free to reach out to me if you have any questions regarding not only this episode, but any other episodes that we have talked in the past. Have a great day, and we'll see you again next week.